Gary DeWaal here, and this is Bridging the Week for January 26th to 30th, and today is February 2nd, 2015. Happy Groundhog's Day, and good morning. Both swap execution facilities and clearinghouses received much attention last week. J. Christopher Giancarlo, a relatively new commissioner of the Commodity Futures Trading Commission, severely criticized the Commission's swap trading rules, while an IMF working paper and ISDA offered ideas to help improve the resiliency of clearinghouses. Separately, the Canadian Securities Administrators sought public views on how Canada's swaps trading framework should look. So we can get outside today to see whether Punxsutawney Phil will predict 6 weeks more of winter or a shorter time to spring. Let's get going. J. Christopher Giancarlo, Commissioner of the Commodity Futures Trading Commission, published a white paper that severely criticized the Commission's swap trading rules and proposed an alternative framework that he claimed more accurately reflected congressional intent. When Congress enacted the Dodd-Frank Act in 2010, it did not prescribe specific execution methods for cleared swaps, says Mr. Giancarlo. Instead, it, quote, expressly permitted swap execution facilities to offer various flexible execution methods for swap transactions using, quote, any means of interstate commerce, end of quote. Subsequently enacted CFTC rules that dictate that swaps be executed solely through a central order book or a request for quote are therefore not mandated by statute, claims the Commissioner, and are inconsistent with the fundamental nature of swaps as opposed to futures. Mr. Giancarlo recommends that instead of continuing with overly prescriptive regulation governing SEP trading rules, the CFTC should encourage flexibility consistent with congressional intent. He advocates vehemently that trade execution methods should be permitted to evolve, quote, organically based on technological innovation, customer demand, and quality of service, end of quote. He also suggests that professionals involved in swaps markets should be required to demonstrate qualification, such as professionals in the securities and futures industry, for example, by passing required examinations. Mr. Giancarlo claims that adoption of his vision for the regulation of swaps will achieve, quote, Congress' express goals of permitting swaps trading and market transparency in a well-conceived regulatory framework without exacerbating systemic risk and market fragility, end of quote. Congratulations to Mr. Giancarlo for an exceptionally thoughtful think piece, but let's see where his debate goes. Eric Bloom, the former chief executive officer, and Charles Mosley, the former head trader, were both sentenced to long terms in prison for their roles in the 2007 collapse of Sentinel Asset Management Group and for defaulting customers of more than $665 million US. Sentinel was an investment management firm registered with the Commodity Futures Trading Commission as a Futures Commission merchant that claimed it specialized in short-term cash management for hedge funds, individuals, financial institutions, and FCMs. The firm filed for bankruptcy in August 2007. For his role, Mr. Bloom received a prison term of 14 years, which he will begin serving on April 30th. Mr. Mosley received a term of 8 years in prison that he will begin on July 29th. Both defendants were also ordered to pay restitution of $665 million US. Oppenheimer and Company, a U.S. registered broker-dealer, agreed to pay $10 million US to the U.S. Department of Treasury's Financial Crimes Enforcement Network, or FinCEN, and another $10 million US to the Securities and Exchange Commission in connection with its sale on unregistered penny stocks on behalf of customers. According to FinCEN, from 2008 through 2011, Oppenheimer maintained accounts for 16 customers, including an account in the name of Gibraltar Global Securities, a Bahamas licensed broker-dealer, that engaged in suspicious activity that raised numerous red flags that were ignored by Oppenheimer. Among other warning signals, the customers often sold large quantities of penny stocks when there were no required registration statements, and repeatedly deposited large blocks of securities, many in paper certificate form, and then sold them shortly after deposit, immediately transferring the proceeds out of their Oppenheimer account. In 2005, FinCEN and the New York Stock Exchange fined Oppenheimer $2.8 million for failing to maintain an adequate anti-money laundering program and not reporting suspicious transactions, while in August 2013, the Financial Industry Regulatory Authority fined the firm $1.4 million for violation of security laws and AML breakdowns too. The Canadian Securities Administrators is seeking public comment on its proposal to encourage swaps trading on exchanges or electronic trading facilities in Canada. Among other things, CSA seeks to develop a regulatory framework for so-called derivatives trading facilities, organized trading platforms for swaps, and to require certain swaps to trade exclusively through a DTF. As proposed, all DTFs would have to be authorized by the relevant securities authority in the province it operates, or be exempt, provide facilities for the trading of both swaps required to be traded on a DTF, as well as swaps optionally traded, be regulated like an exchange in Canada, and be subject to additional requirements, for example, duty to act fairly, if it exercises discretion in the execution of transactions. CSA proposes that foreign-based DTFs, such as a U.S. designated swap execution facility, may apply for an exemption in Canada. Comments are due by March 30th, 2015. CFTC Commissioner Giancarlo, meet the CSA. The CSA, meet Commissioner Giancarlo. And finally, a working paper issued by the International Monetary Fund argued that interconnectedness among clearinghouses, or CCPs, may be exacerbated because of the increased volumes being cleared through CCPs as a result of the regulatory reform following the 2008-2009 financial crisis. Moreover, claimed the paper, there are other risks associated with increased reliance on CCPs that should be better addressed by international regulators, including the structure risk waterfalls and loss-sharing arrangements that may increase contagion for surviving clearing members, the dependency of CCPs for liquidity, custody, settlement, and other services on only a limited number of commercial banks that may add pressure on CCPs and surviving clearing members during a crisis, the impact of simultaneous sales of collateral by numerous CCPs during a market crisis that may increase market volatility, and the different interests of authorities in globally cleared markets that may impede effective cross-border solutions to address systemic risks. In response, the paper recommends, among other measures, that international standards be, quote, more prescriptive on the structure of the risk waterfall, end of quote, and that CCP's dependence on commercial bank services be reduced, for example, by using central bank services and maintaining additional capital buffers. In addition, the International Swaps and Derivatives Association issued a white paper giving its views on how a clearinghouse should manage a difficult clearing member default in order to maximize the likelihood that the clearinghouse will survive as opposed to fail. No matter what it will do, the clearinghouse should describe its processes transparently in advance in its rulebook, says ISDA. Well, that's it for this week's Bridging the Week. As always, there is more information in each article, and more articles on the article version of Bridging the Week on the website. Check it out. Until next week, this is Gary DeWaal, and has anyone seen my groundhog? Ciao!